Hello everyone, it's my pleasure today to share my latest thoughts on markets and implication on portfolio positioning. In the past 2 years, we have experienced the fastest, steepest and most synchronized increase in interest rates this generation has ever experienced. Yet the global economy has been resilient, something that has surprised us. As such, we ask ourselves, has the global economy managed to come out of this rate rising episode mostly unscathed, or are we just experiencing a delay in the functioning of the transition mechanism? We think it's the latter. We think the transition mechanism is delayed rather than broken. Households may have been resilient thanks to post-COVID stimulus and high excess savings, but corporates is where we expect the stress to manifest itself, and this matters because for the first time in 30 years, corporate debt as a percentage of GDP is higher than that of households. And while corporates have yet to feel the full effect of interest rates, it would take an unusual decoupling of the global economy from the bank credit cycle to avoid a recession. It's important to stress there has always been a recession when bank lending has tightened in the manner it has done so in recent quarters. And we think that cracks are just emerging. For instance, bankruptcies are already on the rise. Moreover, a global leading indicator is sending broad-based signals that the industrial cycle is now past its peak, and in particular the European economy, where the transition mechanism is being felt faster due to a much higher proportion of floating rate lending, we think faces imminent recession risks. So what does this mean for us and how we position portfolios? We remain cautious at a time when the investment community, on balance, has more recently embraced a soft landing narrative. We think this is a complacent view. As such, we have been increasing exposure to high-quality duration assets in the portfolio in areas such as US Treasuries and investment-grade bonds. Treasuries not only provide very attractive nominal yields, but for the first time in almost 15 years are offering positive real yields. We think these dynamics, especially in the context of falling inflation, make high-quality bonds attractive standalone, but also as a hedge towards a deterioration in the global economy. With a cautious stance, there is one asset class that we think is particularly mispriced, and that is US high-yield credit. It's been particularly resilient so far, but as many existing debt arrangements are approaching maturity in a year's time, and the Fed reiterates its higher for longer stance, this is not welcome news for this part of the credit market. We are very light in US high-yield bonds as we don't think spreads compensate for the rising default risks. We do, however, also see plenty of opportunities across bonds and equities. For instance, within fixed income, one of our preferred markets is emerging market local currency bonds. They offer attractive real and nominal yields, they offer steeper yield curves, and the general price of goods and services is likely to decline, and central banks that have proven very credible over the past few years. Attractive valuations also mean that they offer some cushion in the event of volatility picks up, helping to mitigate losses compared to other asset classes. Within equities, one of our preferred markets is Japanese equities, which have performed very strongly this year and we think have the scope to move even higher. Japanese exporters continue to benefit from the weakness in the Japanese yen, while the more domestically focused companies benefit from growing domestic demand on the back of higher wages, but also inflation in goods, which for the first time in 20 years has the scope to change consumption behaviors. And there are more positives with Japanese equities, from reforms that are well received by the investment community all the way to buybacks which can support valuations. We have also been flexible in using cash and short-term investments for liquidity and nominal income. For instance, We raised the cash allocation at the end of last year, close to 10%, when bond and equities showed positive correlation, but trimmed that to less than 1% towards the end of Q2 of this year, as we found more attractive investment opportunities in other areas. To conclude, we remain cautious as we think higher interest rates will lead to stresses in the corporate world, which in turn will lead to a meaningful deterioration in economic activity, something that markets are not priced in for. As such, we are building more defensiveness in portfolios through higher quality bonds, but also by focusing on margin of safety in our growth-seeking exposures, with the aim to generate stable payout and downside protection for our investors.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书或投资人须知。